Welcome to Remarkable Retail Podcast, Season 11, Episode 3, or there's that, the German 3. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, our very special guest is Lauren Steinberg, Executive Vice President and Chief Digital Officer, that's new for her, at Loblaw. Lauren is a retail veteran. Loblaw Digital for close to 12 years, and most recently was Senior Vice President of Loyalty, Retail Media, Digital. She's probably one of the most impressive executives in a group of very impressive executives, is not running one of the line businesses. And Steve, while they're a Canadian-based retailer, mostly almost exclusively operate here, I'm pretty sure their reputation exceeds our borders.
Oh, for sure. Well, I've known about Loblaws since the 90s, probably, just because they were known to be just this incredibly successful grocery store. But in particular, and we talk about this a little bit, it was their private brand strength. That was something that was really interesting back then. Now, obviously, that has morphed over time, but they were a real pioneer in that space. And of course, in the last few years, we've talked about this on the podcast. Some people, talk about in the context of trading down, but what I think has been interesting about their private brand strategy for multi-decades is it's really basically a powerful national brand, right? Like, I think there's probably a lot you know better than I would being Canadian, but I don't know if people even necessarily think about it as, kind of like Kirkland's at Costco, right? Like it's such a powerful brand unto itself that happens to be a powerful differentiator. But Loblaw is one of the biggest retailers on the planet. Just happens to be mostly in Canada, but lots of great lessons from Lauren with all her vast experience and a lot of the exciting things they're doing there.
Now, I saw on social media you were on a stage this week at UTD, University of Texas in Dallas. Do I have that right?
That's right. There's a relatively new retail innovation center at the University of Texas at Dallas, which is, 40,000, 50,000 students, something like that. And I was very honored to be asked to give the opening keynote at the very first conference. And I think we're going to maybe talk a little bit about a couple things that I talked about on stage, but congratulations to them they got a great turnout. They put together a really good mix of industry speakers. Aparna from Amazon Web Services, who I've seen speak before, she always brings the heat and brings a lot of wisdom. Of course, a lot of conversations about agentic AI, which, I think every conference now you can barely, kind of like devote the whole agenda. But it was a lot of really great content. Plus, it was fun to catch up with some people and meet some new friends as well, and sign some books and all that good stuff. So it was good time. And for a first effort, it was very, very impressive.
Fantastic. And I want to get back to something that you and I were talking about off mic about RH that came up in the context of that event and things you've been thinking about. So we'll get to that. We'll talk about RH specifically a little bit later. All right, let's jump into news of the week. And I guess for the listeners out there who are thinking we're the tariff and economy show, not much actually happened in the world of tariffs this week. Although my vibe is that the implications, particularly of things like de minimis, which are very immediate, are starting to kind of not dawn on people, but kind of be seen more so and be more evident. Talk about what you're seeing.
Yeah, I think it's becoming more apparent. We just got through earnings season, and as we talked about a little bit, several big retailers said that they are raising prices, that it is hitting their bottom line. We'll talk about that also a little bit more when we talk about RH. So I think the impacts are becoming more clear. What I think is going on more broadly is how the tariff impacts are starting to get into more economic policy. And so, for example, the European Central Bank, they had their meeting last week, and they talked about the interest rate environment, their growth expectations, and they're starting to see really a more steady economic environment. No need to raise interest rates, but talking about how the global chaos, supply chain issues, intercountry trade is starting to affect the growth outlook, which is overall fairly tepid. In the U.S., we continue, of course, it's like every week there's some new macroeconomic indicator that people are trying to figure out. There was a comment from Mark Zandi, who's the chief economist at Moody's, who I've followed for quite a while. And actually, he spoke at an event. I met him 15, 20 years ago now, but he said inflation is uncomfortably high and it's accelerating. And of course, we were in an environment a year ago or whatever when the high inflation was coming down quite a lot. But this week, we got some news that food inflation is really starting to tick up. Just a couple quick stats. Roasted coffee, of course, a lot of that comes from Brazil, where there are very high tariffs, up 22%. Uncooked steak, so, as opposed to buying it in a restaurant, that's what we mean by that, up almost 17%. Eggs, which of course were a big story during the Biden administration, had come down a lot, now going back up. And
that's more economics. The last time eggs went up like that, it was the avian flu, which had kind of killed the herds, which takes some time to repopulate. But this seems more inflationary than kind of connected to that. Yeah,
I think there's still a little bit of a lag there, but much more other factors driving that. One of the interesting things, which I think we'll be hearing more about as we get into the next quarter of earnings, is apparel prices had a pretty long trend of coming down. Now, some of that was the mix because the off-price retailers and the discount, Amazon, Walmart gaining share but that trend is now starting to reverse. We're starting to see actually some apparel price increases, and presumably that is apparel driven, but also energy prices. You think about the things that are going to limit the discretionary income that consumers have. I mean, that's the thing to really be concerned about. Energy prices, both electricity, which is being driven by AI, just these massive data centers, but also natural gas prices are up quite a lot. Healthcare costs, of course, are a big influence on consumers' ability to have discretionary spending. Now, they've, in the U.S. anyway, continued to grow much higher than inflation, seems like for decades. But they're about to go up a lot next year, largely because of the so-called Big Beautiful Bill. So I think consumers, as they start to sign up for their healthcare choices, whether it's on the so-called Obamacare of the exchanges here or through corporate, I mean, those we've seen, estimates of them going up between 8 and 15%. So that is going to take a huge bite out of particularly consumers that don't have so much money. Yeah.
Well, and for consumers that are value shoppers, it's it eliminates discretionary shopping, basically, right?
Right. Yeah. So that's very concerning. So, the thing that actually, by the time most people are listening to this, will have already been decided, which is what the Federal Reserve is going to do with interest rates. Because of the weak job numbers that we talked about last week, and there was some indication this past week of some further slowing in the labor market, the sense is that's giving the Federal Reserve the license to start cutting interest rates. But the inflation rate, that's kind of the offset. So we'll see what they decide to do. I it's always dangerous to make a prediction where 24 hours later the news is going to be there. My guess is they're going to do 25 basis points, not 50, because of the inflation concern. But it's also going to be just more interesting to see what the commentary is, because obviously one move is not setting the direction. But what we're seeing pretty much around the world are interest rates are already lower than the U.S. And for the most part, the cutting cycle has paused, where it looks like the U.S. is really just going to kind of get started. So we'll see what that all means for the future.
All right. Well, it's a very dynamic environment. We got even more global turmoil this week, and the economic chickens are coming home to roost, if I could continue the egg metaphor. Let's talk about. You mentioned RH. Let's talk about RH. Right. Some news on RH, and once again, you brought it up in the context of some of the thinking you've been doing about how you take a business and a business model and change and create ambition and growth. But talk about what's going on with Restoration Hardware.
Well, last week, so there were two pieces of news which kind of prompted me to add it to the list this week. One is they opened what looks to be a spectacular new Paris store. You can go see pictures on the internet, 7 stories. They've really taken their food offering apparently up to the next level. It's on the Champs-Élysées, so it's a beautiful historic building. If you know the RH galleries, you kind of get the general sense for how I don't know, over the top is maybe not the right word. Maybe remarkable. Maybe I'll go with that.
Oh, but there you go.
In any event, so that was something that's been in the works for a long time and looks quite spectacular. The other thing is they did report their their earnings, and they were quite strong. They obviously are continuing to gain market share. Operating margins are very high. The home industry has been very stagnant, but they've been able to put up some strong sales and earnings in that environment. And but they did get good deed goes unpunished by Wall Street. They did warn, as we might imagine, that tariffs are going to have an increasing impact. And they've been doing a lot of moves. I won't get into the details of this, to shift their supply chain, some of it outside of China, some of it to the US. And that's a big project. They've been working on it for a while. And there are also some concerns. They have these new stores are very capital intensive. They're fairly highly leveraged. So there's a bunch of things going on. They just
opened another one before Paris. I guess this is their French theme. They opened one in Montreal at a fabulous new Royal Mount. But so it's not like they're one store at a time.
Yeah. So anyway, that's maybe a topic for a different day. But the reason why I want to bring up RH and in the context of the conference that I spoke at last week, I got asked, I get asked the question a lot of who has gone from basically either completely stagnant growth or really struggling to really reinvent themselves in a fundamentally different way. And there aren't that many stories, and RH is one of them. And just a little bit of quick history: when Gary Friedman became the CEO in 2001, the business was basically on the brink of bankruptcy. And so he did a lot of things, I guess you could say, were more incremental in terms of addressing some of the fundamental problems in the business, introducing new product. I mean, some people may remember that they went from being kind of a tchotchke hardware store to more bath and other kinds of things, linens, those kinds of things. So there were a number of moves that were great growth increments and changed the stores to a certain degree. But more or less 2010 was the big breakthrough, where the team came up with this RH gallery concept. So instead of these smaller stores that were nice, but not incredibly aspirational, they rolled out their first store that was this palace, basically, of home furnishings that not only had these incredible displays, beautiful architecture, but also some of them have pools, coffee shops, fine dining, et cetera, et cetera. And that has evolved to where they have opened the Paris store. They will be opening a store in Mayfair in London next year. They've got this estate, that so-called countryside store, which is 2 hours outside of London, which has other things going on, which again, don't have time to get into. But the reason why I say is, I think if you've got, and we always use the department store example, but if you've got, it could be Toys R Us, it could be Bed Bath & Beyond, these businesses that at one point had a very viable business model, but started to become irrelevant, basically. My question always is, will incremental change get you to where you want to be? And so what I found myself saying when I was talking about this in front of the audience was, if you're a struggling brand, tell me where you're trying to end up. What I sometimes refer to as Earth 2. If Earth 1 is becoming uninhabited, and you can't think of a way to save it, which may be a little bit true in reality here on Earth,
a little close to home a little bit.
What's the future destination? And I can tell you from my experience at Sears, to a lesser degree at Neiman Marcus, but certainly what we've seen with many of the category killer type stores or department type stores, which were incredibly powerful in the 80s and 90s, and not so much for the last 20 years, they never articulate a very exciting future destination. It's great to improve your merchandise assortment and have more sales help and change the lights and fix the carpet and all that kind of stuff. But does anybody believe that those companies are really going to be an exciting future destination? And so what RH did is they created something that leveraged a lot of their expertise, took some of their customers with them, but created something really powerfully different. And yes, they had to test it, and yes, it's evolved, and yes, it's risky. But the riskiest thing at RH, and people have heard me say this before, I'm sure, the riskiest thing at RH was to continue to try to drag the corpse around and prop it up and do a lot of incremental change. That might have made them better, but it was never going to make them great. And I think that's the challenge that we see with the Kohl's. It's the challenge we see with, office supply store. Like a lot of these businesses which have been going nowhere for many, many years, most of what they're trying to do is incremental, and they've never really articulated where you're trying to get to, and is that an exciting destination? And that has implications for people wanting to work there and stay there. That has implications certainly for attracting investment. So anyway, I think the RH case example, I mean, they've done some things wrong, they have some risks, et cetera, but they're really somebody who's aimed higher, moved fairly fast given the capital intensity, and been much more bold. So anyway, lots of issues there, certainly with tariffs. They're slowing down the pace of their openings to try to get their balance sheet in a little bit better place and just understand really what they're dealing with in terms of the influence in the business. But anyway, I think RH is a great story of what I mean about leaders leaping, and you can go see it and see how different it is. And if you remember,
you don't have to imagine it. You can. Here's the case study. Is this going to work?
And if you remember what their stores looked like 10, 15 years ago, it's pretty obvious. So, do the same thing at an updated Macy's versus a Macy's they haven't touched. And you're like, yeah, it's better, but is it that exciting? Maybe not.
Let's talk about remarkable stories. So what do you want to raise up, and what have you been thinking about in terms of remarkability?
One of the stories from last week that's gotten a fair amount of buzz, so maybe some of our listeners have taken a look at it, but if not, I want to lift it up, is the digital transformation at Sam's Club. And there are several things I think are really interesting about this. One is just, and I know we've talked about this in the context, many people will know Sam's Club is part of the Walmart family, and just this idea that big, complex, ossified, maybe in some cases, organizations can still do some really innovative things. And so we've usually talked about that in the context of the Walmart brand, but Sam's Club is doing a lot of interesting things, and people might want to go back and listen to our interview with their president, Chris Nicholas, earlier in the year. But what they just rolled out to 100% of their members, because it is a membership warehouse club, is a new presentation layer on their app and their website. And what that means really is, as the consumer comes in any kind of digital experience, whether they're sitting at home checking things out, which of course, many people might plan when you go to a warehouse club, tend to buy a lot of stuff. So you may be doing some research and planning what you're going to buy, but also while you're there, doing scan and go checkout and a lot of other kinds of things you can do. They've really taking that to a whole new level. So I'd ask, if you're a Sam's Club member, you just want to go check it out, see kind of the state of the art of what people are doing and you may have to be a member to see all this stuff, but more personalization, greater integration between the physical and digital experience, more video, creating capabilities to deliver more ads on the platform, which of course is growing very, very quickly and is becoming a big profit driver. So, in terms of the implications of this and why I would suggest people go check it out is, number one, and this is a little self-promoting here, but a lot of things that they're doing are very much tied to the 8 essentials of remarkable retailer, like really being human-centered in the approach you take. So they talk about this as being people-led and tech-enabled, but really thinking about it as largely I don't love saying digital first, because clearly there's lots of things that are still analog that are important.
Sure.
RH is a great example of that, right? So you need to tailor that to your particular customer and category experience, but leveraging the latest and greatest in digital technology, integrating across the different channels. As a membership organization, of course, they have a ton of data. I mean, you're basically a logged in customer, so they can leverage that data and make it a more personal experience. But I think a lot of what they've done, and I've heard, you and I heard Tom Ward speak at the Commerce Next Growth Show. He's their chief operating officer, and he's responsible for their end-to-end customer experience. I think you can really see how that's playing out. I mean, when he talked about it, we didn't know that this was about to come out, but I think you can really see it in how they've looked at the customer journey and found ways to take the friction out, to amplify the wow. So anyway, I think it's really impressive to see kind of an old dog learn new tricks, but really kind of see the state of the art in many respects of what retailers are doing.
Well, and I'd just add, like, listening and reflecting on what you've been talking about it's really the epitome of this, these aim higher, move faster. That can be at a big retail. Big retailers can move higher
Absolutely.
and aim faster. This isn't just for nimble
Well, and there
startups, right?
were from some of the, I mean, I don't have firsthand experience with this, but some of what's been reported, they've been testing this and progressively rolling it out. So part of the announcement was, it wasn't just like this was behind the scenes and boom, everybody has it. They've been testing it, refining it, and last week was when they really put it to the whole chain. So it's very much a test and learn thing, and that's part of the way you get speed, right? Is and manage your risk. So it's not reckless. It's just smart innovation.
Yeah, absolutely. All right, let's talk about the next phase, the next act, a peek around the corner. What's on your radar screen for the next coming weeks?
A few things really quickly, and ties back to what we were just talking about. I mean, the direction of interest rates in the U.S. anyway is very important, and we'll see where that goes. Now, it's important to say that just because short-term interest rates come down doesn't mean long-term interest rates are going to come down, and that's much more important to things like the home industry really getting back on its feet. So anyway, we are going to be in a little bit of a dark period. We're pretty much done. We've got one more big retailer that I can think of that I'm particularly interested in, Costco, and I'll talk about them just in a second. But one of the things that's great about earnings season is we get a peek under the hood at what is going on at particular retailers. We get to hear them talk about what's driving their business, what they're looking at. Well, now we're going to have a couple months before Amazon reports, and then we start in the string of earnings reports. So it's going to be a little bit unclear. So unless companies do an earnings warning or for whatever reason speak about some bigger trends, we're going to be a little bit dark here as we move into the holiday season.
Okay.
I guess the other thing is kind of related to that, and I've heard people start to refer to it as mini stagflation. So some people may remember that I talked about the worry that we would get in the US anyway to a period where we start to have meaningful inflation again and growth really slows. And that's a very difficult place to be for a bunch of reasons that people can probably imagine if they don't know. And I think the narrative that's somewhat starting to develop is growth's probably not going to be terrible. I think the whole idea we would go into a recession, not too many people seem to think that's very likely anytime soon. But if growth slows meaningfully and inflation starts to tick up and we get the squeeze that we were kind of alluding to earlier, particularly for lower middle income consumers, that's a pretty vexing place to be, and that could lead to layoffs, and that could lead to a bunch of other things. But anyway, last thing is Costco's earnings. They're the third biggest retailer on the planet, I believe. That's definitely the third biggest in North America. They've been growing quite nicely, and their commentary about how they're growing because of the trading down phenomenon, just consumers being more value conscious. Part of this narrative I've talked about a bunch of just so much growth being concentrated in the hands of just a few retailers. They're one of them because they've been growing 6-7% when the industry's been more around 4%. So they report, I guess, the week after, or I guess next week. So we'll see what they have to say and whether that gives us any clues to what the holiday season is going to look like and what 2026 is going to look like.
Well, I certainly admire Costco for a whole bunch of reasons, and I think they're a great bellwether. It's how people find value in very different ways, right? Than value shopping. So they're an interesting bellwether because it captures a sense of the market. Both value to them is being able to buy large size to get scale and per unit cost, right? It's a very different kind of thing.
Yeah. And the other thing I think that's important about Costco, which I think sometimes people overlook now, even though it was very much the origins of the warehouse club model, is a good percentage of their customer base are small businesses. So not only are you're getting a read on the consumer, you're often getting a read on smaller businesses. So they're able, I think, to distinguish between individual versus corporate membership. So that'll, to the extent that we think small businesses are getting squeezed maybe a little bit harder by some of the tariff stuff, maybe we'll get a little bit of a glimpse into that.
Let's leave it there. We'll be back next week with another exciting edition, backed by popular demand, of The Analysts. Stay tuned.